In the frenetic world of cryptocurrency, where price is king and narratives shift by the hour, the most powerful and reliable signals are often not found on the chart itself, but in the collective emotional state of the market. Right now, we are witnessing a profound and telling contradiction, a market climbing a powerful wall of worry, while sentiment gauges scream panic. Understanding this dynamic is not an academic exercise. It is the key to identifying where we are in the cycle and anticipating the next major move. The factual, objective data is unambiguously bullish. Bitcoin, the digital bellwether, has staged a dramatic recovery, surging from the $80,000 floor to smash through the $90,000 barrier in a decisive pre-holiday move. Simultaneously, traditional finance's benchmark, the S&P 500, is flirting with its all-time highs, indicating a broad-based risk on appetite in global capital markets. On the surface, this paints a picture of pure, unadulterated strength. Investors should be euphoric, greed should be palpable, and the momentum should feel unstoppable. Yet the most widely watched sentiment indicator in crypto tells a completely different story. The Crypto Fear and Greed Index is currently mired at a shocking reading of 16, categorized as extreme fear. This is not mild apprehension or healthy skepticism. This is the kind of psychological terror typically associated with market capitulation and bottoms, not during a $10,000 Bitcoin rally. This glaring disconnect between price action and investor psychology is the central paradox of the current moment, and it is packed with significance for the forward-looking trader. This fear is not baseless. It is deeply rooted in powerful, recent market trauma. The memory of the precipitous drop from the $126,000 cycle high is still fresh and painful for a cohort of investors. For many, that decline confirmed a deeply held belief that the 4-year cycle top is definitively in and that we have now entered a prolonged bear market phase. Every rally in this narrative is not a new beginning, but a dead cat bounce or a bull trap, a fleeting opportunity to sell before the next leg down. This belief system creates a powerful, self-reinforcing loop. As price climbs, fear doesn't subside. It intensifies because participants are waiting for the other shoe to drop. This is the wall of worry that healthy bull markets are famous for climbing. The psychology is further fractured at the individual level. Consider the newer investor who heeded the call to buy the dip around $82,500. They are now suddenly sitting on a significant unrealized profit, a position that ironically breeds anxiety, not confidence. The haunting question shifts from when will I be made whole to do I take this profit now or do I ride it out? This profit taking anxiety acts as a constant, latent selling pressure and feeds the sentiment meters that measure fear. It creates a market where gains are constantly being locked in, preventing the kind of parabolic, FOMO-driven melt-up that characterizes cycle peaks. This environment of extreme fear amidst rising prices is, counterintuitively, one of the most constructive setups for a sustained advance. It is the precise sentiment backdrop that allows rallies to mature. Why? Because it means the market is not yet overcrowded with weak hands and exuberant, late-to-the-party capital. The fuel of sideline cash remains vast. The pervasive doubt provides a steady stream of sellers at various levels, allowing the market to advance in a staggered, controlled manner rather than in an unsustainable vertical spike. Most importantly, this sentiment chasm creates a massive different market participants, while retail sentiment meters flash red, the smart money, comprising institutional players, seasoned whales, and algorithmic capital, is not paralyzed by fear. This is not a minor trend line. It represents the foundational baseline of its entire 2024 trading range and a level that aligns with the critical 0.618 Fibonacci retracement of its last major impulse, wave, a level often defended aggressively. The thesis for Solana is binary and clear. As long as $131 holds on a weekly closing basis, the structural integrity of its bull market remains intact. From this springboard, the path opens toward significantly higher targets at $274 and eventually $323, representing a potential move of 135% to 145%. The risk is equally defined. A sustained breakdown below $131 invalidates this immediate bullish structure and opens the trapdoor toward a much deeper consolidation, potentially back toward the $85 region. This setup epitomizes a high-conviction, high-clarity trade. Patience at this precise support is the prerequisite for the next explosive leg. The immense trading volume and institutional interest in Solana mean that a successful hold and reversal here would likely be violent and rapid, catching a hesitant market off guard. 2. Avalanche. AVAX. The compressed spring at historic lows. While Solana's setup is about holding a pivotal level, Avalanche presents a different kind of opportunity, the accumulation thesis at multi-month compression. Despite a steady drumbeat of positive fundamental news, including high-profile ecosystem development and validator growth, the AVAX chart has been a picture of frustrating stagnation, grinding at the lower bounds of a protracted range. This dissonance between price and progress is the core of its appeal. Technically, AVAX is compressing against a critical $15 floor. This level represents not only the 6-month low, but also a backtest of the 2024 yearly low. In market structure, such a prolonged consolidation immediately following a deep decline often represents a redistribution phase where weak hands capitulate and stronger, patient capital accumulates. This is a high-risk, high-reward zone by definition. The risk is that the support breaks, leading to a new leg down. The potential reward, however, is asymmetric. When an asset with a robust fundamental backbone, a thriving ecosystem, institutional partnerships, and technological upgrades finally breaks out from such a coiled spring, the expansion is typically violent and covers vast distances quickly. The initial target upon a sustained breakout above the consolidation range is a full-range recovery move toward $98. This is not a short-term prediction, but a measure of the pent-up energy. The comparison to XRP, years of sideways agony before its historic multi-week rip, is apt. Avalanche at $15 is not a trade for the faint of heart. It is a strategic position for those willing to assume the risk of further boredom or downside for the potential of catching a foundational ecosystem-led rally that could deliver exponential return. 3. Sui. The acknowledgement of weakness in the strategic scale. In contrast to the previous two, the analysis of Sui is a masterclass in objective risk management and strategic patience in the face of a clearly weak chart. Despite swirling rumors and speculative hype about potential major partnerships, the price structure of Sui remains bearish, trading near its lows and exhibiting the characteristics of an incomplete downward correction. The technical work here is invaluable for its honesty. The chart reveals a likely ABC corrective pattern still in play, with the final C leg potentially targeting a deep, high-volume support node clustered around 83 cents. Approximately 50% below current levels. This is not a prediction of certain doom, but a mathematical projection based on the symmetry of the existing wave structure. Identifying this possibility is what separates strategic investing from hope-driven speculation. The actionable insight here is the methodology, not a bullish. For an investor convinced of Sui's long-term fundamentals, this analysis advocates for a scale and approach around current levels and down toward that 83 cents target zone, rather than a single all-in entry. This averages down cost basis while respecting the market's clear technical message. The level for confirmed bullish invalidation of the downtrend is set at $1.70. A reclaim of this level would signal the corrective pattern is likely complete, and a new uptrend may be beginning. This triage of setups, Solana's pivotal hold, Avalanche's coiled spring, and Sui's cautious scale provides a spectrum of strategic responses to different market conditions. They collectively underscore a central tenet of navigating altcoins. The greatest opportunities often lie not in the euphoric green candles, but in the quiet, fearful consolidation of well-defined technical extremes, where the market's narrative and its chart are poised for a dramatic, thus profitable convergence.